Hello, everybody, and welcome back. Last week, I did a video on business structure and its tax impacts. And during that video, I mentioned this little concept called equity as part of the decision-making process when deciding what business structure you wanted to make. However, I didn't go into detail because it really does need its own video, so that's what we're doing today. I have a little presentation for you, so in a minute I will share my screen so that we can go over that. I actually have a case study. What I need you to know is that I am simplifying this so that you have a basic understanding and can ask questions as well as understand some of the things that may have already happened to you. Some of you have already experienced equity impacts in that your businesses have suffered very large losses, and yet somehow you manage to have to pay capital gains tax. And 9 times out of 10, it has something to do with equity. Also note that I tend to use the word basis, not equity, interchangeably, but mostly I'll use basis. Just remember that those are the same thing. So without much further ado, I'm going to go ahead and I'm going to share my screen. And there we go. You should be able to see my wonderful title page talking about basis for partners and S corporations or S elections. Now, those are the businesses that I work primarily with that this has the most impact on, so that is what I will be focusing on. Also, before we get started, I would love it if you're on YouTube, if you could hit that subscribe button, or if you are watching me on Facebook, if you wouldn't mind following Misty Lineberger CPA. I'm also on LinkedIn, so feel free to find me there, or if you're watching me there, go ahead, send me an invite, and I will certainly accept it. I think it's a great community, and we're all learning from each other, so hopefully this is very helpful for you as well. All right, when is basis a thing? Well, for my clients, it's a thing when they form a partnership, take the S election, or they form a full-on S corporation. So pretty simple, that's when it becomes a thing. I do want to talk about partnerships for a minute because I did not mention them in the last video, primarily because partnerships are taxed very similarly to sole proprietors or LLCs that have not taken the S election. The partners are subject to self-employment tax, although there are some smaller differences, for example, tracking of equity or basis, and the fact that there is a 1065, which is the corporate return that needs to be filed for partnerships that result in K1s that flow through to the partners and report their proportional share of profits, losses, capital gains, other income, all of that fun stuff. So it can take the S election if it wants to, or if it makes sense, certainly not just once. Let's make sure it makes sense as well. Now, as a refresher from last week, S elections and S corporations are taxed exactly the same. An S election, though, is an LLC that is chosen to be taxed as an S corporation without actually being one, which means they still get the elimination of the self-employment tax, but they have fewer compliance issues to deal with. And with the S corporation, it's also a lot less expensive to form and maintain. The S corporation, again, is much more expensive to form and a little bit more expensive to maintain each year, but still experiences the same tax benefits that an LLC with an S election does. These two things generate what's called an 1120S, which generates, again, a K1. It's called a K1S, so that the proportional amounts of income, losses, and other fun activities that a business may do are passed on to the owners. And here is an example of those forms. There's a K1S, again, generated by the 1120S, and a K1P, generated by the 1065. And as you can see, there are some structural differences between the two K1s because things are generally done slightly differently for an S corporation than they are for a partnership. So just keep that in mind. Today, I'm going to be using an S corporation or an S election as an example, and just know that when calculating basis, that it is slightly different for a partnership, but I didn't really see the need to go through two examples. All right, when basis becomes important, you've got a couple of different types. You've got tax basis, which is what I'm primarily going to be discussing today, and that is what is reported on your tax return. And then you have outside basis, which is the basis in the company after a few other things happen. But that's more in terms of between you and the partners and what the value of the company is. So I'm really not going to touch on that today, and that may be a video sometime in the future. So, of course, there are types within types because nothing can be super simple. All right. So, within the tax basis and outside basis, you have stock or partnership basis, and you also have debt basis. Now, stock and partnership basis is made up of a few different things. It's made up of the money or property you have contributed to the company, whether it's in terms of your percentage of the partnership or for shares, it's the money you've contributed. It is subtracted by the money or property that's been distributed. And on those two items, I'm going to talk in terms of money today. I'm not going to talk about property because it can be a little complex and doesn't really need to be part of the conversation in order for you to have a basic understanding of how equity works. But just note that property does factor into it as well. And then it's also it goes up or down depending on what your proportion of profits and losses are. So clearly profits increases your basis, losses decrease your basis. Now, debt basis, I want to talk about this for a minute. So you have owners that may loan money to the company, and they do that by going to the bank and taking out a loan that they are personally responsible for paying off regardless of whether the company survives. That is an example of a loan that is at risk. So if an owner provides money to the business that is at risk, they now have what's called debt basis. So you can, and it's for the amount of the loan. And the debt basis goes up when that money is put in, and then it goes down for a couple of different factors. For example, it'll go down when you're paid back, and I'm going to show you how it goes down if the company experiences losses as well. So just hold tight on that one. So we do have an example coming up. We have a little case study for an S election, S corporation. Again, remember, a partnership would work slightly differently, but just minor differences. So I'm just going to focus on the S corporation, S elections for the moment. So this case study, Misty is the majority owner of an LLC that has chosen to take the S election. She contributed $20,000 for her stock and then loaned the company another $10,000, and we're going to assume that is at risk. During the first year, the following K-1 information was reported. So we have a fairly significant loss. Her proportion of it is $45,000. She has interest income of $300. There's a cash contribution of $500. So again, this is her taking money from her pocket and putting it into the business. There's a distribution of $8,000, and then there are non-deductible expenses of $1,800. Now, non-deductible expenses are expenses that are legitimate business expenses. The business spent money on them, they are legitimate expenses, but we just can't put them on the tax return for whatever reason. Examples of this would be charitable contributions or meals and entertainment. Travel meals, only 50% of those are deductible. There are a lot of meals that happen within a company that are legitimate business expenses, but they're just not tax deductible. So just keep that in mind, that that's something we also keep track of. All right, so what do all those numbers mean? Well, I want you to look at the very first column, which is stock basis. And as you can see, it starts off at $20,000 because she contributed $20,000 at the beginning of the year for her stock, okay? And now we're going to add those things in that increase her basis first. That is always the first step. So we have $300 in interest, and then we have a $5,000 contribution that she made. So that brings her stock basis up to $25,300. Now the next step is to take into account those non-deductible expenses. So she had $1,800 of those, so that brings her basis down to $23,500. Now, one of the things you need to understand about basis or equity is that for tax purposes, equity can never go below zero. Now, I know there are a lot of times where on your balance sheet you are showing negative equity, and I understand that, but just note that you can't, for tax purposes, go below zero. So you've got book and you've got tax, and right now we're focusing on tax. So of that $45,000 loss, for tax purposes, she can only decrease her stock basis by $23,500. So that's not the total amount of the loss. So what happens? Well, she happens to have some debt basis, right? Because she put some at-risk loan money into the company. So that was $10,000. So she happens to have $10,000 debt basis. And now we can take an additional $10,000 loss. Now, if she didn't have that debt basis, she would be stuck at just taking the $23,500 loss and then carrying forward the rest of that loss. But nope, the debt basis does allow her to take an additional 10, so that reduces her debt basis down to 0, and she gets the tax benefit for that loss. So keep that in mind. I really need you to keep that in mind here in a minute. So that leaves a carryover loss of $11,500 that we get to carry over into future years until it's been used up. However, do you see this other column here that says capital gains? She owes capital gains taxes on $8,000. And if you'll recall, that $8,000 was a distribution. And the problem is she doesn't have the basis to take that distribution. So what happens is it becomes something called return on investment, and she has to pay capital gains tax on it. So that is what happens right there when owners experience large losses in their companies, but somehow manage to have to pay capital gains tax. That is exactly what happens right there. There's another way it happens as well, although it happens a lot less often, and we're going to go ahead and we're going to go into year 2 and show you how it can happen the second way. All right, so in year 2, Misty did not make any additional contributions or loans to the company, but the company did pay her back for the $10,000 she loaned it in the first year. During the second year, the following K-1 information was reported. She has a business profit of $15,000, and keep in mind that is her proportion of it. Her proportion of interest income is $500. She took a $10,000 distribution. She made no cash contributions this year, and there are non-deductible expenses of $1,000. Okay. Well, of course, we're going to start year 2 off with a $0 stock basis for tax purposes, because remember, you can't go below 0. Well, we're going to add the positives in, right? So we're going to add that profit, we're going to add that interest income. So now her stock basis gets up to $15,500. And then again, we have to reduce it by the non-deductible expenses. So now we're down to $14,500. And then we took a $10,000 draw. Okay, she has the basis to take that $10,000 draw because there isn't anything else after that point. So that leaves her with $4,500 basis. However, there were losses the previous year she was not able to take advantage of, so we get to take $4,500 of those carry forward losses, and then that brings her basis back down to 0. So that distribution did not trigger a capital gains situation, and we still have $7,000 of loss to carry forward into future years. Now, debt basis, remember, she was paid back that $10,000. But also remember, I told you that she received the tax benefit of the $10,000 additional loss she was able to take in year 1. So she's already received the tax benefit, which means that you don't get it again. So the fact that she was paid back all $10,000 in year 2 means she is going to experience a $10,000 capital gain and have to pay taxes on that. So that is another way in which you can wind up paying taxes on something with carry forward losses. You would think that you wouldn't be generating a tax liability at all. So it's really, really important to be keeping track of these kinds of things. That pretty much sums up my example for today. Just again, remember that for partnerships, it's done a little bit differently. I don't recommend that you do this yourself, that you try to contact a professional that helps you work your way through the basis situation. You also need to know that it's very important to keep in mind when creating your business structure. Okay, so hopefully that helps. Now you can ask questions. Feel free to reach out to me, comment below, and I will get back to you as soon as I can. I'm pretty responsive most of the time. Now, next week, I'm going to be talking about the PPP forgiveness application. So that's going to be another presentation, and we're going to run through the 2 different applications there is for that. They have the PPP forgiveness easy application and then the regular application that they've modified for the new legislation. So hopefully we'll all find that helpful. I've worked through it. I've spent many hours on it, and I'm feeling confident it will be helpful to you. So we'll see you next week. Take care, everybody. Thanks for joining.